The last 5 years before you retire, what are you doing? That is super huge. Retirement, I call it the retirement red zone. 5 years before you retire, 5 years during retirement. What are you going to do? How is your money situated? Are you moving stuff from volatile accounts to accounts that could be more safe and secure, still have compound interest working? How is that going to work? Well, ladies and gents, here to drop a few cents, you were Earl, the money coach, a decade license in the financial industry, and 2 decades of investment portfolio experience. I want to sit down and break this down why it's so important. Have this topic because I have a client that turns 65 in 2 months, but with the volatility in the market, 2020 hit. This year we're having stuff hit. They've had all these blemishes and they don't know what to do. They had their money in very risky accounts. So I want to have some steps on how you could prepare and focus and get yourself ready for retirement as you're entering that retirement red zone. But make sure you guys like, follow, and subscribe, and check the link in the descriptions below to get your life insurance, your health savings accounts, and business owners. If you're looking for 6 figures to get approved for loans for your business, check that out. But let's get started with this. It is so crucial to make sure you understand that the 5 years before you're in retirement, you're starting to transition. Now, when I say transition, I'm talking about moving your money from volatile accounts, risky accounts, to stuff that could be safe and secure. How do you do that? That could be from rollovers, strategic rollouts, from budgeting, investing in certain things with different criteria. I'm going to break that down. I got the computer here so you guys kind of have a little bit more realistic statistics on what's going on right now. But let's get into number one is playing catch up. A lot of folks know if you have a 401k, you have an IRA, you have a certain contribution limit. But as you're getting closer towards retirement, those that are older, you could actually put in a little bit more. So if you have any kind of retirement account, your 401ks, your IRAs, things of that nature, where you could put in a little bit more than everyone else, start to utilize that strategy to the pretty much best of your abilities. Now, understand that also some of these accounts, especially your 401ks, they can match you. You want to make sure that you're matching up to whatever percentage that they have. If they match you 4%, put in 4%. Don't put a little bit more, but make sure you could get up to that match. But if you could contribute more as you're older, make sure you do that, especially as you're getting towards these last few years. Now, number two, you have your rollouts. Some companies, not all, it depends on your job, they let you for some retirement, some of your volatile accounts have what we call a in-service distribution. Now, Earl, what's an in-service distribution? Plain and simple. While you're working at a career, while you're working at a job, some companies will allow you to do an in-service distribution, which allows you to start accessing your retirement funds while you're still there if you want to move it to another location. Now, there are pros, there's cons. One of the cons I tell people is most companies don't do it. Go talk to your HR, your finance department, the benefits specialist, whoever it is, to see if that could be done. And most of the time, you have to be of a certain age, a lot of times 55 years old or above, to be able to access in service distributions. But that is a possibility where you can start to look at moving your money. Or you could have a strategic rollout. So, what's the difference between a rollover and a rollout? When you have a rollover, you have a large lump sum. You got $200,000 in the 401k. You're looking to roll that into another strategy. Roll your IRA to another strategy. That's your rollover. But depending on how it's taxed, you might have taxation on it if it's qualified or non-qualified. If it's qualified to be taxed, you're going to have to pay taxation on it, taxes on it. That's your rollover. Now, a strategic rollout, what that is listen, I have a large lump sum, 200,000. Instead of having that huge hit on taxes, let me strategically move a little bit per year, move a little bit per year so that the tax bracket on that amount that you're moving doesn't hit you as much. So you have your rollovers and strategic rollouts. It's something you could look at if you're still working, like your 401ks and stuff. Like I said, you could have an in-service distribution, which could be an option. Or heck, if you want to start having a playing catch up and overfunding, putting a little bit more since you're older now, that could be a great strategy. Now, the second thing I want to talk about, I want to get these numbers, is managing your debt. Folks, debt is so huge. We know that you have the average person about 9,300 in credit card debt. You have your student loans, you have your vehicles, all these kind of things. You want to minimize those debts as you're getting towards retirement, because most people that retire, they're going to be making less income. So if you have less income coming in and you still have a lot of debts, guess what? It could be a financial hardship. It could be a burden. So you want to start these last 5 years that you're getting down your taxes. I mean your debts. If you have credit card debt and you have the debt avalanche or the debt snowball, go ahead and start implementing these strategies to knock that out. Vehicles, the same thing, knock that out. A lot of people do what? You get every 4 years, every 5 years, people are buying new vehicles. Maybe hold off temporarily so you can get that down so you can start maximizing everything else out there. If you have your student loans, you can look for student loan forgiveness. There's a lot of strategies. I have a client that I got her student loans from 119,000 down to 37,000. So a great strategy that you could use for some of these student loan forgiveness programs, consolidation programs. You could look into those, especially now where you're hearing a lot of stuff where they may be garnishing your wages. Is that true or not? We're going to see in the next upcoming months. So focus on getting your debts, because like it shows right here, the average person in retirement, within 4 years, they actually have to go back to work. 54%. So 54% of people who retire have to go back to work. And a lot of times it's because they have debts and all these things that are still out there, their mortgages, so on and so forth. They retire and they don't have that same income coming in. So you want to make sure you start getting these debts down as soon as possible as you're entering that retirement red zone 5 years beforehand. Now, another thing is you want to finalize your retirement budget. That is huge. Now, when I say finalize your retirement budget, what I'm saying is as you get into retirement, you need to know what your bills are going to be. If you still have a mortgage, if you still have a car payment, if you're still taking care of your children's education, whatever it may be, you want to have a finalized budget. Now that I'm going to be hitting retirement, my budget is going to be $4,200 a month. If I leave my career, guess what? I may have to have X, Y, and Z in place so I can supplement to that income. So you want to make sure you're finalizing your budget so you could plan accordingly to what needs to be done. The reason why I say that's huge, a lot of people have a retirement goal, a target. I want to retire at 65. I want to retire at 67. If I got $1 million saved up, I'm good to go. Great plans, great goals. But if you don't have that budget, trust me, that money could go a lot quicker than you think. So when I say focus on that in your retirement red zone, the 5 years beforehand, you want to look at how am I going to be living, start strategically planning and understand if you're going to have enough supplemental income. Supplemental income is how you're going to cover what you initially were making. You got 401k, you got stocks, you got social security. All these supplemental incomes, you're getting 1,500 here, 1,200 there, 1,100 here. Is those supplemental incomes going to be enough to cover your financial burden and your financial budget that you're going to have in retirement? So you really need to know this amount so you can start to gauge what's going to be going on. Which then after that, we're talking about social security. Now, here's the thing about Social Security a lot of people don't understand is if you have taking Social Security and you have a certain amount of income you're still bringing in, your Social Security can be taxed up to 85%. Right now, single, if you're single, filing single and you have over $35,000 of income coming in, even if that's including your Social Security, your Social Security amount could be subject of up to 85% taxation and taxes on that Social Security. Meaning, if you get $18,000 for your Social Security for that year, 85% of that 18,000 could be subject to taxes. So when you're filing taxes the next year, so many people hit retirement, and what happens? They end up having to pay taxes instead of getting taxes back because they were not aware. Oh, I still got a side gig. I'm just working something just to stay busy and collecting Social Security. You brought in 45 grand for the year. Now you're getting taxed on that Social Security. You weren't expecting that. So you need to understand how that works. Not only how Social Security works, if you're going to have a full Social Security, if you're going to the full age of 67, so on and so forth, how much more money will you get if you retire at 62 compared to 65, compared to 67? Is it worth it, number one, or is it going to be enough to be supplemental income for your retirement? So understand how Social Security works, because people always ask, why is there so much issues with Social Security? Understand this. When Social Security was created, right, the average life expectancy was only 61 years old. So for Social Security, for pensions, life expectancy was 61 years old, but retirement was 65. Meaning, when Social Security was initially designed, they didn't have it in mind for people to be on it for a long time. Hey, you live to 65, you may be on Social Security for a year or two, bam, you're good to go. And when Social Security first came out, it was 42 to 1. Now, what does that mean? That means for every 42 people putting money into Social Security, one person was taken out. So you have 42 workers providing, one person taking out Social Security. Now, 2025 is dropped down to 3 to 1. So for every three people working, one person's taking Social Security. And now the average life expectancy isn't 61. We're talking 85, 86, 87. So you went from most people not getting to the age of needing retirement Social Security to dang near everybody needing Social Security for the next 15, 20 years. That's why you see that, is Social Security going to be around? Is it enough for enough people? We don't know. So you want to factor in, is Social Security going to be around? Is it going to be enough? And even if I get Social Security, if I'm on a limited budget during retirement, am I going to have to pay taxes on that? So you want to factor all these things in those 5 years before you get to retirement and that retirement red zone. I can't tell you how many people are shocked and surprised when this happens. And now, a huge one, healthcare. Folks, healthcare is huge. 70% of people over the age of 65 will have a long term care need. Let me say it again, 70%. So 7 out of 10 people you know, once they hit retirement, once they hit 65, they're going to have a long term care need. They're going to get sick. They're going to have health issues. People do not plan or budget a retirement that's filled with a health issue. I talk about that myself. You know, my father was in a nursing home for 3 years. It was 8,200 a month. So pretty much six figures a year, like 97, 98,000 a year. 3 years, that's 300,000 of the 450,000 he had planned for retirement, gone, wiped out just to stay healthy. So are you planning if you're going to have health needs? Now, we're talking from Medicare, Medicaid on that side. Do you have your life insurances? Life insurance in place so you could get long-term care, you could get living benefits. Do you have that? What about your HSAs, your health savings accounts? Do you have health savings accounts that you started, you're funding, and that also could be part of a tax advantage strategy to use for part of your retirement? Folks, focus on health. Health is wealth. I cannot tell you how many clients I sit down. We're talking millionaire clients that end of the day they have health needs. A lot of things are going on. I have one gentleman, you know, multiple seven-figure income every year, had a triple bypass for his heart. You know, dang near passed away. Wasn't in shape. Wasn't healthy. Focus on your health as you're getting ready for retirement. That could be from, like I said, your medical, your Medicaid, whatever, your Blue Cross Blue Shield, whatever you're using, health savings accounts, life insurances, all that, but also get your butt up and get yourself in shape. One of my fitness instructors tell me a classic 2,000, 10,000. What's 2,000, 10,000? It's eat less than 2,000 calories, take over 10,000 steps every day. Intake less than 2,000 calories. So you're eating less than 2,000 calories and you're taking over 10,000 steps a day. You do that consistently, that's actually very beneficial for your health. It gives a lot of good things to help you out, keep you active, keep you moving, keep your energy levels up, but also keeping you healthy. So you want to make sure you're taking care of that, because you don't want to be that 70% of people who you worked all your life, you busted your ass all your life, and now what happens? I'm sick, I can't do what I want. So many people go through that. So you don't want that to happen. Now, one of the last steps is deciding when to retire. A lot of people don't know when to retire. You need to have a date, you need to have a target. If you don't have a target, how do you expect to hit something? If you don't have a target, how do you expect to hit something? Now, for retirement, that target is a number, and that's financially, how much money you need financially. I have what I give my clients, what we call the FIN, the FIN, your financial independence number. That's how much money you need to retire and have interest paying out so you never have to work again. My conservative number, a lot of times you see online 2%, 4%. We're pretty much at 6% now. What does that mean? Your financial independence number needs to be something that could pay out 6% yearly just off the interest, because wealthy people don't live off their money, they live off the interest their money makes. Now, how do you figure this out? How do you figure out your FIN number? It's very easy. Take your monthly expenses, times it by 12, because it's 12 months in a year, then divide it by 0.06%. So what does that mean? Take your expenses, not your income, your expenses. Let's say your expenses are $5,000 a month. $5,000 a month, times that by 12, which is $60,000 a year. Then take that 60,000 and divide it by 0.06%. Not multiply, divide. So when your calculator, in this case, you're going to put 60,000 divided by 0.06, that should equal $1 million. It's going to be a large number. I'm not going to lie. Whatever your expenses are, times it by 12, divided by 0.06, it's going to be a big number. In this case, it's $1 million. So 5,000 a month, 60,000 a year, divided by 0.06% is $1 million, which means once you have $1 million in any kind, I don't care if it's the mutual funds, uh, stock market, municipal bonds, ETFs, insurances, REITs, whatever you're doing, what could give you a conservative 6% from all your accounts? Because if you have $1 million, a conservative 6% paying out will be $60,000 a year, and you could take care of your expenses. So have yourself a target. Now, the question is, are you going to wait to 65 to hit that million, or are you going to do it by 55, 45, however old you are? But we're talking about right now the 5 years before you retire, that retirement red zone. So you need to figure out your FIN number, your financial independence number, and then plan and strategize around that to be able to make sure everything's good to go. I cannot tell you how huge that is. Out of all the steps that I'm talking about saving, about budgeting, about your health, contributing to your strategies, all that's good. But the FIN number, your financial independence number, is the most important, because you need to have a target to be able to hit. That way you can get to retirement, folks. That's huge. And like they say, like I said earlier, 54% of people who retire have to go back to work. Most of them just don't know what they need. And now, some of the few other ones is creating an income strategy. You want to be able to create an income strategy that gives you supplemental income. How am I going to get money every single month that's going to be good for me? If it's my 401k, my IRAs, my stocks, my ETFs, my life insurance, my fixed index annuities, whatever it is, create an income strategy so you know that every month I have XYZ coming in. I have X amount of dollars from these kind of accounts. If it's my social security, so on and so forth, you want to make sure you have an income strategy. So once you're in retirement, you are not worried about having enough funds. You're not worried about running out of income, because a lot of people, they just say, "Oh, I got 200,000 in my 401k." They don't know what the heck to do with it. "Oh, I got this money coming in from my stocks. I don't know what to do with it. I don't know what capital gains are going to be. When I get this large lump sum, what do I do? How do I take it out and draw it out slowly?" They don't know. So have a income strategy that could really be beneficial during retirement. At that time during retirement, hopefully you don't got no bills. You know what I mean? All your bills are taken care of. But if you do have bills, you want to make sure that income strategy is, if something needs to be paid on the 5th, the 15th, and the 27th, you want to make sure that you have certain income from either Social Securities, 401s, whatever investment you have that could cover those kind of things. So you want to have that proper income strategy. Now, two more steps. This is huge: estate planning. So many people don't think about estate planning when it comes time to retirement. Everyone wants to leave a legacy, but most people leave a liability. Why? They don't understand how probates work. They don't understand how to move everything. Oh, I have a will. I want to leave this for my kids when I pass away. Not understanding how taxes work. That's why having your will is great, but understand having a will, understand a trust, understand having a trustee, how to move things from yourself to your family to avoid probates. $2 billion is lost every year due to probate. $2 billion. So this is huge. You want to make sure you're planning this out. And also your funeral. People don't talk about that. You know, for funeral, do you have funeral insurance, burial insurance, final expense, all the same thing, different ways you could say it. Do you have this that could be the bridge between you and your family and your actual beneficiaries getting everything? Why is that important? So many people I got $1 million of life insurance. I got $3 million in the business. I got a house. I got all this stuff. When someone passes away, you have to wait for the death certificate and all that's taken care of, squared away before your beneficiaries could access those funds, could access those investments or whatever you have, which could take anywhere from 1 to 2 months. I have one client, it took almost 3 months to provide the death certificate. Is the funeral home waiting for that? No, they're not. That's where your final expenses, all that stuff comes into play, which could pay out within 24 to 48 hours. So you could take care of that as everything else is being switched from you to your beneficiaries. So having a will, look into that. Have a trust, look into that. If you want help with those, feel free to reach out to me or schedule an appointment from the links in the description below. But you want to make sure that you have all that. But ultimately, is preparing for a lifestyle change. This is probably the biggest thing. Now that I'm in retirement, I don't know what the heck to do. I don't know what to expect. I always say this. One big thing is a lot of people actually start to diminish, their health diminishes. All this stuff happens when they get to retirement because you're not moving anymore, you're not active, you're just binge watching TV, you're not doing anything. So their health diminishes. So you need to have a plan. Prepare for a lifestyle. Are you going to be doing stuff more active? Are you going to be, helping the grandkids out? Are you going on travel, vacation? Are you going to have a hobby? Do you like gardening, doing something on the side? Plan for that lifestyle change because that is one of the big reasons so many people financially run out of money in retirement. They don't plan for the lifestyle change, so they do what? They start splurging. Oh, I don't got nothing to do. I don't got to clock in to work. I don't got to worry about anything. So now you're just having bottomless mimosas in the middle of the day. You're just going to the beach for the weekend, which you want to have done. Now you're spending 300-400 bucks on a hotel. All these kind of things. People don't plan this out, and that could be a huge thing. So you want to put in a plan for that lifestyle change. And when I say that, is it going to be, am I doing XYZ quarterly? Am I doing this every month? Am I going to be helping out family that needs help? What am I going to do? So, folks, these are huge steps that you need to focus on when it comes to getting ready for retirement. The 5 years before, the 5 years after you retire, that 10-year period, the retirement red zone. But those 5 years before retirement is critical because if you have your money in these volatile accounts where you could take a loss, if you don't have a plan, if you're not budgeting, if you don't know how you're going to live that lifestyle, if you don't take care of your health, if you don't have that strategy, any one of these areas could truly mess up your retirement. This, folks, is what I call a financial GPS. Now, what does GPS stand for? GPS stands for grow, protect, and save. How are you going to grow, protect, and save your money correctly so you can have that financial plan, that financial GPS to get through retirement? Just like a regular GPS. If you don't know where you're going, how much time and gas are you going to waste? Same thing with retirement. If you don't know where your financial GPS is, if you don't know where your retirement is going, how much money are you wasting? How much time are you wasting? How many people could have retired 10, 12 years ago, but they didn't have that financial GPS? So, folks, you're here with Earl, the Money Coach. I hope these tips are huge. Those 5 years before you retire, that retirement red zone, 5 years before, 5 years after, make sure you're working on those, guys. And make sure that you like, follow, and subscribe. And check the links in the description to get approved automatically for your life insurance, for health savings accounts, and for business owners. You're looking to get a loan to start and have a business venture crowdfunding. Check those links out. Appreciate you guys staying by, watching the video. I'll see you on the next one. Take care.